Stop scrolling. You need to understand this right now. The entire global gold market rests on a single, invisible wire. One price, everywhere. That wire is about to snap. A new rule has created the perfect arbitrage trap. It's a point of no return for the banks at the center of the system. They can get in, but they cannot get out. This is not theory. This is a mechanical failure unfolding. Once this arbitrage breaks, there is no repair mechanism, only containment. This video is not about the price of gold going to the moon. It is about the system's plumbing breaking down. It's about trust evaporating in real time. Watch this carefully. I'm going to show you the exact mechanism that fractures the global gold market. Not at the price level, but at the settlement layer. This is what breaks first. To understand the threat, you must see the magic trick. The entire system is built on the assumption of one global price. Gold works as a single, worldwide asset because it is designed to clear at one price everywhere, enforced by a relentless process called arbitrage. Normally, the price of gold in the major trading hubs, London, New York, and Shanghai, stays almost perfectly synchronized. The spreads are often less than 0.1%. If gold on the New York COMEX exchange trades even slightly higher than the spot price in a London vault, an army of traders at bullion banks pounces. They instantly buy the cheaper physical gold in London and sell a futures contract in New York, locking in a risk-free profit. They then physically ship the gold from a London vault across the Atlantic into a New York vault to settle the trade. This constant fluid movement of metal welds the prices together. Picture a vast, invisible web of banks like HSBC and JP Morgan, constantly shuttling massive 400-ounce good delivery bars between their vaults in London, New York, and Zurich. These bars are the lifeblood of the entire operation. This frictionless flow is built on two giant assumptions: seamless logistics and total government neutrality. It assumes a bar of gold is a bar of gold, no matter its location. But when that assumption breaks, the illusion of one price shatters. The entire structure begins to fail. When you think of gold trading, you picture the chaotic pits of the New York COMEX. That is not the heart of the market. The true center of the gold universe, ground zero for physical settlement, is London. The London Bullion Market Association, or LBMA, runs the world's largest and oldest marketplace for physical gold. This is not a formal exchange like the NYSE. It is a massive, over-the-counter market where major banks trade directly. The scale is staggering. The London market clears over $50 billion in gold trades every single day on average, a figure that dwarfs public exchanges. Most of this trading is for Loco London gold. This is the key. Loco London means the trade settles in London, but bars are not moved with every transaction. It is a giant bank clearing system, but for gold. The major bullion banks hold accounts with each other denominated in ounces of gold. A trade is simply an electronic debit or credit between these accounts, while the physical metal stays in a London vault. This is the core of the system. Everything else is built upon it. The LBMA also sets the world's benchmark price twice a day, the LBMA gold price, used by everyone from central banks to jewelers to value their holdings. The COMEX futures market in New York, where so much public price discovery occurs, is completely dependent on London's deep pool of physical metal. COMEX contracts are for smaller 100-ounce or 1 kilo bars. But the ability to deliver on those contracts relies on the vast ocean of 400-ounce good delivery bars in London. Sever the connection between New York and London, and the COMEX market becomes unglued from physical reality. The world's biggest gold ETFs, like GLD, also store their thousands of tons of gold in these same London vaults. Without London, futures pricing in New York unravels. If you find this look at the market's hidden plumbing useful, subscribe and hit the bell. We go deep on systemic risks like this every week to show you how the financial system really works. Understanding these weak spots is the first step to protecting yourself. We have a finely tuned global machine, built on the free flow of gold from London. Now we throw in the wrench, a new, seemingly boring 2% tariff imposed by the US on gold imports. Suddenly, the arbitrage holding the market together is broken. Remember the trader buying cheap in London to sell high in New York? Let's run the numbers. A single 400-ounce bar at $3,000 an ounce is worth $1.2 million. The arbitrage profit might only be a few $1,000s. A 2% tariff on that $1.2 million bar is an immediate, unavoidable cost of $24,000. The profit vanishes. The trade dies. The arbitrageurs stop. They can no longer afford to ship gold from London to New York to close the price gap. The frictionless flow freezes solid. The consequences are immediate. The price of a COMEX futures contract in New York depegs from the physical price in London. We have seen previews of this. During the logistical chaos of 2020, the New York premium exploded to over $60 an ounce. With a tariff, this is not a temporary glitch. It's a permanent structural break. You could see a world where New York gold consistently trades tens or even hundreds of dollars higher than London gold. The one price rule is gone. This is where the real crisis ignites. It's not about different prices. It's about what those prices do to the banks. Bullion banks are not supposed to bet on the price of gold. They hedge to be market neutral. A classic hedge is to be long physical gold in their London vault, while being short an equal amount of gold futures on the COMEX in New York. When the prices are identical, the positions cancel each other out. Gold goes up, they make money on their physical, lose it on their futures. They are insulated from price moves, making money on fees and financing. But when the tariff breaks that price link, the perfect hedge is violently ripped apart. Suddenly, the price of their asset, London gold, no longer moves with their liability, New York gold. The two prices diverge. This creates a basis risk that generates massive, terrifying losses. Imagine their New York short position bleeding cash as the COMEX price spikes, while their London physical gold fails to rise enough to cover the loss. The hedge is broken. This is chaos. The banks are exposed in ways they never intended. They face enormous margin calls on their futures positions, demanding billions in cash immediately. Trust in the system evaporates. Who will extend credit when a counterparty's balance sheet has a billion-dollar hole that appeared overnight? The plumbing itself has fractured. Before gold's plumbing fractures, an early warning sounds. Silver. Historically, during systemic stress, the smaller, more volatile silver market is the first to show delivery failure. It is the canary in the precious metals coal mine. Silver is far more fragile than gold. Its physical inventories are much thinner. Over half of its annual demand comes from industrial consumption, meaning it gets used up in products like solar panels and electronics. The paper market for silver also has far greater leverage than gold. Some estimates suggest hundreds of paper claims exist for every 1 ounce of deliverable physical silver. That fragility is being tested now. China, a dominant force in silver refining, has begun restricting exports to secure its own domestic supply. It continues to import silver, but limits what it sells to the world. This creates a one-way flow, breaking the global arbitrage mechanism more severely than a tariff. You cannot ship silver out of China to close a price gap if the government forbids it. This makes physical delivery from that entire region impossible at scale. When settlement stress hits the silver market, the bullion banks lose money on their silver hedges and are forced to reduce risk across their entire portfolio. A crisis in one metal creates a liquidity crunch in all of them. This forced de-risking accelerates the very fragmentation in the gold market we've been talking about, as banks scramble to unwind positions in a system where they can no longer trust the price. When a crisis like this hits, understand one thing. The exchanges and the banks will protect themselves first. Their priority is not ensuring you get your gold, it is the survival of the clearinghouse and its members. Faced with a delivery system broken by tariffs, an exchange like the COMEX has several emergency levers. It has used them before. The most dramatic recent example was the market stress of March 2020. As the pandemic shut down flights and refineries, the physical pipeline from Europe to New York seized. The COMEX price disconnected from London, soaring to a massive premium. There was a genuine fear of a delivery default in New York. Open interest for the April contract ballooned toward 20 million ounces, while registered COMEX stocks were under 9 million ounces. COMEX changed the rules mid-crisis. It rapidly created a new delivery mechanism allowing 400-ounce London bars to help settle its 100-ounce contracts. They effectively imported London's liquidity by changing the rules of their own game, calming the panic and preventing mass defaults. But the ultimate backstop is more controversial: cash settlement. Deep in the rulebooks, exchanges hold the power to declare force majeure. Instead of delivering the physical gold you were promised, they can force you to accept a cash equivalent. The problem is, what is the fair cash price in a broken market? The inflated New York price? The lower London price? A price the exchange simply decides? This is the ultimate betrayal of trust. You believe you own a claim on physical gold, but in a crisis, you discover you only own a claim on cash, at a price set by the very institution under stress. This is not a bug, it is a feature. The system is designed to protect its members from a cascade of defaults. Forcing cash settlement is how it stops the contagion. This leads to the most critical point. A fracture in the gold market is not about the price hitting $10,000 an ounce. It is about the foundation of trust in the global financial system cracking. Gold is supposed to be the ultimate settlement asset with no counterparty risk. It is final. But the modern market is built on a mountain of paper claims, derivatives, and unallocated accounts layered on top of that physical bedrock. The leverage is enormous. When the settlement layer breaks, it exposes a dangerous fact. Most people do not hold gold. They hold a promise from a bank. A tariff creating a permanent split between London and New York reveals these promises are not all equal. A claim on gold in a New York vault is now fundamentally different and more valuable than a claim on gold in London. This triggers a chain reaction. Trust in the massive gold derivatives market frays. The European Central Bank has already warned that shocks in the physical gold market could trigger massive margin calls and spill over into the wider financial system. ETFs, which rely on these same banks as custodians, would face a crisis of confidence. If your custodian's hedges are blowing up, how safe are the bars they supposedly hold for you? The price of the ETF itself could disconnect from the value of the metal it is supposed to track. This is what a real crisis of trust looks like. It isn't a dramatic price chart. It is the quiet panic that spreads when you question if the asset in your account is actually there. It is when institutions question the integrity of the market's plumbing. The system erodes not with a bang, but with the slow, creeping realization that the rules can be changed. The one price was an illusion, and a promise to deliver gold is not the same as gold itself. For decades, the global gold market operated on an invisible assumption: frictionless settlement. A single price, enforced by arbitrage, created one seamless global market. That assumption is fragile. The plumbing is more important than the price. A single new rule, like a targeted tariff, clogs that plumbing. It drives a wedge between the world's biggest markets, shatters the one price rule, and turns safe institutional hedges into sources of catastrophic loss. The response, as we have seen, is for the system to protect itself by changing the rules and breaking the promises that give paper gold its value. This reveals a deeper truth. Global assets do not break in the headlines first. They break at the settlement layer, in the boring, back-office mechanics that everyone takes for granted. As geopolitical friction and trade disputes rise, these foundational structures will be tested again. It leaves one question: what other invisible assumptions is the entire global financial system built on? and which one will be the next to fracture.